On the 16th of February, Bank of America issued a warning that the stock market could drop by 40%. They sent this message out when the S&P 500 was trading above 6,000 points. Since then, the index has experienced a 20% decline as a result of Donald Trump's new tariffs. But believe it or not, Bank of America sees a much larger underlying problem. Comparing today's market to two of the biggest bubbles in history, the Nifty 50 of the 1960s and the dot-com crash of 2000. If they are right, the stock market's recent 20% drop may only just be the first phase of a much larger bear market, potentially taking US stocks down by an additional 20%. Their warning points to a major red flag. The market is heavily concentrated. You can see that in this chart, showing the proportion between US and global equities. The first big bump in the late 1960s shows the so-called Nifty 50 bubble, when around 50 large-cap companies dominated the market. They were seen as fail-safe blue-chip investments and drove a bull run that led to a massive crash in the 1980s. This bump is the dot-com bubble of the early 2000s, when investors were dazzled by a flock of new internet companies, which led to yet another crash. Right now, we're way up here. US stocks, led by the Magnificent Seven large-cap companies, make up an outsized share of the global market, the highest level in 75 years. This chart shows the proportion of the S&P 500 made up by its biggest 5 companies. You can see the peak before the dot-com boom and an even bigger peak today, when just 5 American companies now account for more than 26% of the S&P 500. So, are we in a bubble? And if so, how do you protect yourself? One of the driving forces behind this concentration is passive investing, especially index funds and ETFs. Over 54% of the market is now controlled by passive strategies, where money flows into indexes like the S&P 500 regardless of individual company valuations or fundamentals. This has turbocharged the growth of the largest stocks. Think of it like a feedback loop. The bigger a stock gets, the more weight it has in the index, so passive funds buy even more of it, pushing valuations higher. For example, the Magnificent Seven, companies like Apple, Microsoft, and Nvidia, have seen their market caps balloon partly because of this autopilot buying. But this dynamic also amplifies risks. Passive funds don't care about overvaluation. They just keep buying based on index weightings. This can create market inefficiencies, like stocks trading at prices disconnected from their earnings or cash flows. In a downturn, the process flips. If investors start pulling money out of these funds, say due to a recession or an AI hype unwind, passive strategies are forced to sell those same overweight stocks. Because the largest stocks dominate the index, this selling can snowball, overwhelming the market's ability to absorb it. That's the liquidity risk Bank of America is worried about. There simply might not be enough buyers if everyone heads for the exit at once. Just look at so-called new economy stocks, which are made up of tech, communication services, and consumer discretionary sectors. With the AI frenzy, they now represent over 50% of the S&P 500's market cap. If these stocks drop 50%, Bank of America estimates the S&P 500 could plunge a whopping 40%. This would take the S&P back to the 2020 level lows, essentially erasing 5 years of stock market gains. But while today's market does share similarities with the Nifty 50 and dot-com bubbles, there are also important differences. Look at the fundamentals. While the market is more concentrated today, the Magnificent Seven do have better fundamentals behind them. They have bigger cash reserves and higher profits than the leaders of the dot-com bubble. Their stocks are also cheaper, as shown by their lower 24-month forward PE ratios. Some investors also argue that the high earnings per share of these companies justifies the higher stock price and massive valuations. That the stock price and the earnings per share for the Magnificent Seven companies have more or less moved in tandem. If Mag 7 stock prices were instead moving much higher than EPS, that would be more indicative of inflated valuations. It's also worth pointing out that high market concentration is also not that unusual from a historical perspective. Kind of like the ebb and flow of the business cycle, the economy has historically passed through phases of high concentration. In the early 1800s, it was finance and real estate companies. Then transportation, particularly rail companies in the late 1800s. Energy and materials took over in the mid-20th century, and now we're seeing a dominance of information technology and communications. So if a major correction is on the horizon, how can investors protect themselves? Bank of America outlines 3 key strategies. First, they recommend paying attention to the performance of the equal-weighted S&P 500 index versus the cap-weighted version. Historically, cap-weighted dominance lasts about 4 years before the trend reverses. Right now, we're several years into cap-weighted outperformance. Second, an investor could consider leaning towards ETFs and indices with less exposure to the Magnificent Seven. According to Bank of America, ETFs like Invesco S&P 100 Equal Weight ETF, EQWL, which provides equal weight exposure to the S&P 100 companies, can mitigate the impact of the largest tech firms. And third, diversify. That way, if a major correction happens, your portfolio is less exposed to the fallout. The AI boom is real. Innovation is pushing markets higher. But history has shown that every boom eventually faces a bust. Whether we're in a bubble or not, smart investors are watching the warning signs and positioning themselves to survive whatever comes next. At Capital.com, we'll continue to keep you updated on market trends with videos like these. Thank you for watching.